Today we're answering the question at hand. How can you invest in a private company? By the end of the video, not only will you discover how to tap into the massive market of private companies, which by the way makes up 99% of all US businesses and generate nearly half of all economic activity, but you'll also learn 3 powerful strategies to find and evaluate private investment opportunities. Well, they're the ones that most investors miss.
One of the nation's top real estate investors. Within only 7 short years, Dave Seymour has transacted millions of dollars of real estate and has become one of the nation's leading experts in both residential and commercial transactions.
You know what really fascinates me about the business world? Right now, as we speak, 99% of all US businesses are actually private companies. These private businesses are the backbone of our economy, generating nearly half of all economic activity and employing millions of Americans. Yet so many people never even consider investing in them. And I get it, the world of private company investment can seem mysterious, mystifying, maybe even a little bit intimidating. But what if I told you that getting started with private company investments isn't as complicated as you might think? In fact, by the end of the video here, you'll have a clear roadmap for how to tap into this massive market opportunity. And trust me, there are some strategies here that even experienced investors often overlook. Now, before we dive deep into how to, there's one major mistake I see people over and over again make when they try to invest in private companies. This single error has cost potential investors not just money, but incredible opportunities. I'll reveal this critical mistake shortly, but first, let's talk about what makes private companies different from the businesses you can invest in on the stock market. You see, when most people think about investing, their minds jump straight to the stock market, buying shares in companies listed on the exchanges like the NYSE or the NASDAQ. However, private company investing works quite differently, and understanding these differences is key to your success. Think about it this way. When you buy stocks in a public company, everything's standardized. The shares are clearly defined, prices are set by the market, and you can buy or sell whenever you want, right? It's like shopping at a major retail store when everything has a clear price tag and a return policy. But with private company investing, it's a little bit different though. There's more like visiting an artisan marketplace, if you will, where every deal is unique and negotiable. See, what private companies, with them, every deal can be unique. You get it? Sometimes you might buy straight ownership of the company, or you might get something called a convertible note. Don't worry, we'll talk about that more in a minute. Other times you might even set up a deal where you get a share of the company's future revenues. The flexibility is actually one of the most exciting parts of private investing. It lets you structure deals in ways that work best for both you and the business. But it also means you need to understand what you're getting into, right? And that brings up something really important: how these private companies are valued. You see, with public companies, determining value is pretty straightforward. Just look at the stock price. But with private companies, well, things get a little bit more interesting. The value is often determined through negotiation, which means you need to know how to assess a business's worth or work with someone who does, one or the other. Don't worry though, I've got some practical tips coming up that'll help you navigate this as well. However, something crucial you should absolutely need to know before getting started is that private investments typically aren't the kind you can cash out of quickly. They're an investment. Unlike public stocks where you can sell with the click of a button, private investments often need time to mature. We're talking about years, not days or months. But here's the thing, this longer term perspective often comes with the potential for much bigger returns. Now there are different ways that you can actually invest in private companies, and you might be surprised by how accessible some of these are. The first approach is the direct investment, where you buy ownership in a private company yourself. Now, while this might sound like something only millionaires can do, I've seen successful direct investments start with as little as a few $1,000s. Now, the second approach is through private equity funds. These are professional investment vehicles that pool money from multiple investors to buy private companies. Now, you might have heard that private equity funds were only open to millionaires, and that used to be true, but things have changed. It's different. These days, there are options that let you get involved with much smaller amounts than you might have expected. connected. And finally, there is equity crowdfunding. This is a relatively new way to invest in private companies that's completely changing the game by opening up private investing to people who never had access to it before. But there's something very specific you need to know about these platforms. You see, most crowdfunding platforms make investing seem as simple as clicking a button and transferring some money. And while they've definitely made private investing more accessible, there's a crucial step that many investors miss, which is understanding the actual terms of their investment. The fine print matters more than you might think. Okay? Something that might surprise you is the fact that many investors who use these platforms, they don't even realize their investment could get diluted in future funding rounds. That means your ownership percentage might shrink if the company raises more money later. But the good news is, once you understand how these terms work, you can then use them to your advantage. This brings us back to the major mistake I mentioned earlier. The biggest error new private company investors make is rushing into deals without understanding the structure of their investment. See, they get excited about a company's potential, and believe me, I understand that excitement, don't get me wrong, but they don't take the time to really understand what they're buying. So how do you avoid this mistake? It starts with knowing the right questions to ask. When you're looking at a private company investment, whether through a crowdfunding platform or a direct investment, you need to understand three key things: your right as an investor, your exit options, and the company's future funding plans. Let's start by digging into those investor rights for a moment. When it comes to investing in a private company, you might get voting rights, information rights, or pro rata rights. These might sound like boring legal terms, but they're actually incredibly powerful tools. Voting rights let you have a say in major company decisions. Information rights ensure you'll receive regular updates about the company's performance. And the pro rata rights, well, like golden ticket, if you will, let you maintain your ownership percentage in future funding rounds. However, the type of investment you choose can dramatically affect these rights. Remember those convertible notes I mentioned earlier? They're actually a fantastic way to get involved in private equity companies, especially early stage ones. They work like a loan, if you will, that can turn into ownership later, usually with some pretty attractive terms. This is actually a perfect time to talk about one of my favorite strategies, if you will, for private investing. Instead of putting all your money into one type of investment, you could create what I call a balanced private portfolio. Think of it like building a pyramid, if you will. At the base, you might have several smaller investments through crowdfunding platforms, for example. And in the middle, you could have a few direct investments in more established private companies. And then at the top, well, maybe one or two larger investments where you have more control and better terms. Now, speaking of control, let's talk about something that's often overlooked: your relationship with the company's management team. In private investing, this relationship can be incredibly valuable. Unlike public company investing, where you're just another shareholder, private investing often gives you direct access to the people running the business. And that access can give you insights you'd never get from reading just financial statements, for example. But you might be wondering, how do you actually build these relationships? How do you find the right private companies to invest in? Well, that's where networking comes into play, and I've got some practical strategies that have worked very well for me and my clients. But before we get into that, we need to talk about due diligence, because finding good opportunities, well, it's only half the battle. You need to know how to evaluate them properly. Yeah, properly, accurately. You see, most people try to evaluate private companies the same way they would maybe public ones. They look for perfect financial statements, detailed market analysis, and years of documented history. But here's the thing: private companies, especially growing ones, rarely have all of that perfectly packaged information. And that's actually okay, because there's something much more important you should be looking at. The real key to evaluating private companies lies in understanding their core value drivers. Yep, core value drivers. What makes their customers stay? How do they make money? What gives them an edge over their competitors? You see, these aren't just abstract questions. They're the foundation of your investment decision. For example, when you're looking at a private company, start by examining their customer relationships. Are customers coming back? Are they coming back regularly? Are they referring other customers? This tells you more about the company's potential than any financial projection ever could. It's what I call the sticky factor, if you will. How well a company keeps and grows its customer base. Now, this is where most people get stuck. They know they should be networking to find good private investment opportunities, but they don't know where to start. Well, I'm going to give you 3 basic specific networking channels that you can use to get started right now. The first channel is through professional service providers like lawyers, accountants, business brokers, and they all work with private companies. These professionals often know about investment opportunities before they become public knowledge, and building relationships with them can give you early access to promising deals. The second channel is industry-specific organizations. Every industry has its own associations, conferences, and online communities. These aren't just networking opportunities, they're gold mines of information about which companies, private companies, are growing, and they might need an investment. Now, the third channel, it's something I like to call the ecosystem approach. Instead of looking directly for companies to invest in, you build relationships with people in the broader business ecosystem. This includes suppliers, distributors, and even competitors of companies you might want to invest in. They often have the best insights into which companies are really performing well. But let me tell you about something even more powerful than these networking channels. It's an approach that combines networking with due diligence in a way that can significantly increase your chances of success. I call it the, drumroll please, concentric circle method. It's completely changed how I evaluate private investment opportunities. The concept is simple, but the impact is profound. You start at the center with the company itself. Then you work your way outward through circles of increasingly distant relationships, employees, customers, suppliers, competitors, and industry experts. Each circle gives you a different perspective on the company's potential. This method not only helps you evaluate the company more thoroughly, but it also helps you build a valuable network in the process. And here's the really clever part. Even if you decide not to invest in a particular company, those relationships that you built during that process often will lead to other opportunities. It's a true win-win situation. But there's another aspect of private investing that we need to talk about. And this can make the difference between a good and a great investment. This is about how you structure your involvement with the company after you invest. Because in private company investing, your role can be much more than just a passive investor. You see, unlike public company investments, where you're basically limited to buying and selling shares, private investing gives you the opportunity to add real value to the company. And when you add value, you can often negotiate better terms or even create additional revenue streams. Something that I've learned from years of private investing is that most successful private investors don't just provide money, they bring something extra to the table. Might be industry expertise, maybe valuable connections or operational experience. But the approach not only helps protect your investment, but can significantly boost your returns. Remember earlier when we talked about those investor rights? Well, this is where they become incredibly valuable. Let's say you have expertise in marketing. You might negotiate for a consulting arrangement alongside your investment. Or if you have international business experience, you could help the company expand into new markets. The possibilities are really only limited by your creativity and what you can bring to the table. But what's really fascinating about this approach is that when you become more than just an investor, you gain insights into the company, and other investors simply don't have that opportunity. You can spot both opportunities and potential problems early. And that information, well, it's absolutely invaluable when it comes to making decisions about your investment. Now, let's talk about creating synergies between your different investments. This is something that most investors, well, they never consider it, but it's a strategy that can multiply your returns. But it requires thinking about your private investment portfolio in a whole new way. Instead of treating each investment as completely separate, look for ways your portfolio companies might work together. For example, if you've launched a software company and a manufacturing business, could they benefit from working together? Could one become a customer of the other? Look, these kinds of connections not only help your investments grow, but can also give you unique insights into different industries and markets. Now, this all sounds great and all, but what about the risks? Well, it's time to address that head on, because private company investing definitely comes with risks. And anyone who tells you otherwise, well, they're just not being straight with you. However, the key is not to avoid risks entirely. Look, that's impossible. The key is to manage them intelligently. Remember that pyramid portfolio structure we discussed earlier? That's actually one of your best risk management tools right there. By spreading your investment across different types of opportunities, you're not just diversifying, you're actually creating multiple paths to success. And when you combine this with the active value-adding approach we just talked about, you're putting yourself in a much stronger position than most private investors would. Now, if you're interested in getting started with private company investing, here's what I recommend for you. First, start small. Focus on the learning component. Maybe begin with a crowdfunding platform investment. But remember those terms we discussed. Make sure you understand exactly what you're getting. Next, you could start building your network using those 3 channels that we talked about earlier. Join some industry organizations, connect with professional service providers. Start mapping out the ecosystem in industries you understand. Don't rush this part. Good opportunities will come as your network grows, I promise you. And here's something crucial. Start thinking about what unique value you can bring to a private company. What skills, experience, connections, whatever it is that you might have that you deem valuable, can you bring that to the party? This will help you not only find better opportunities, but also negotiate better terms when you invest. Now, before we wrap up, let me leave you with one final thought. Private company investing isn't just about making money, although that's certainly important. It's about being part of something growing, something dynamic. When you invest in private companies, especially if you take that active approach we discussed, you're not just buying a piece of paper, you're becoming part of the story of that company's growth. It's very exciting. And that's really what makes private company investing so special. Yeah, it requires more work than buying public stocks. Yes, it takes more patience, but the potential rewards, both financial and personal, well, can make it all worthwhile. If you got some value out of this video, be sure to like and subscribe and click the bell to get notified when I post new videos. I'll see you on the next video, and you can access it right here.